as an investor, like how do I like stay patient and calm with this volatile market? Because the last couple of years, the market's been going up, and I look at my statement and it's always positive, but now we're starting to see a little bit more red.
Yeah. So it's going to be hard. I'm noticing more angst within the clientele uh, because, again, you go back to 2018, I think the total stock market index was up about 4 or 5% for the year. We had a 20% drop. You look at, there's been a lot of years here that haven't been that great. And, you kind of get used to that. But then you look at 2019, you look at 2020, we had a big drop, but the total market was up a lot. You look at 2021, and so it's been a long time. People have been getting statements that look good month after month after month. And, I always thought it was kind of chuckling myself when somebody asked me, oh, and it was like a 2% down month. I was like, wow, that's wait until we really get a big one. So now we're getting a bigger one. And this is going to get worse before it gets better. I have no problem thinking about that. There's a lot of downward momentum right now. And we've even seen the market fall apart on 2 different days, Wednesday and Thursday of this week, where it was up and then reversed. And matter of fact, the Nasdaq reversed over 1%, which it hasn't really done in 20 years. And so, there's some things happening as far as that goes. But the way to stay calm during this particular thing is to, first of all, that's where the education comes in. It's why we have this show. It's why we put out these videos. I stay calm because I know a lot about the different history of what's going on. So, give you an example. On average, after the first interest rate increase, which probably is going to happen in March, the stock market drops 6% on the S&P 500. But 6 months later, it's actually up 5% in total. And so on average, the stock market makes 10.4% in a year following a year that made over 20. Hey, that's last year made over 20. And so on average, the stock market follows earnings, right? Earnings are up 8.5%. 81% of companies reporting so far have beaten expectations. And this will be the seventh quarter in a row of beating expectations. The leading economic indicator is up, not down, not peaking up in December. Could come down, but it's not happening right now. And in reality, interest rates are zero. Yeah, they're going to raise them. They're going to cut back on bond purchases. They're going to do all these things that will definitely slow things down and certainly impact demand. But so, yeah, I mean, here's some more. I mean, inflation is being caused by demand, which they're going to work on with the Federal Reserve, but it's also being caused by supply chain constraints. What happens if supply chain constraints get better? And I think there's a very good probability that they do. Throughout the end of the year here, we'll probably see supply. That's going to help inflation right there, allow the Federal Reserve to lower rates less. Inflation could be a lot less in the second half of this year. Look at what happens in an average midterm year, going back to the 1920s. Basically, the first part of the year is usually poor. Second part of the year is quite good. So again, if that's true, you want to do opportunistic rebalancing. So what can you do to take advantage? But a lot of it's just kind of understanding, what's out there, what's happened. That's why we do this show. That's exactly why I do this show. And because, negative news sells. If you look at what's out there, and I've said this before, it's one of the reasons we do concentrate somewhat on the positive just as an offset. Negative news is what gets clicks. We'd get a lot more views. I mean, a lot more, like a magnitude more, if this show was negative. If we talked about why the stock market was going to drop 30%. And there's so many of those guys out there. They're all over the place. We're going to have the greatest stock market crash in history coming up right now, that kind of stuff. Lots of clicks. So I think one of the ways to kind of help yourself in terms of your feeling of angst, watch our show. I mean, because we're going to bring you some of the positive pieces, and these are facts. I'll tell you when it's negative. I'll tell you when the leading indicator is going down. I'll tell you when the 200-day moving average is going down. those types of things. But those aren't happening right now. So this is, until they do start to happen at this point in time, in my opinion, we're in what I call a sideways motion market. Again, that doesn't mean it won't go down. Might even go down 20%, but we're still kind of in that trending, motion. That trend was going up, and now that's stopped, and now we're going to go kind of sideways and get really, volatile, which is happening. And then we'll either reestablish an uptrend, we'll have a strategy for that, or we'll actually fall into a full-on downtrend, and we have a strategy for that. But have strategies. That would be another thing. I think that helps, right? Have some plans. What are you going to do? I have plans. I have paths. I have plans for every path that I can think of all the time. I love doing that. And that helps me. I look at downturns as opportunity. So that's another thing that I think helps with, the feelings of angst that you might get, right?
Yeah, and just from a planner's perspective, or whenever we run a plan, we account for markets having downturns.
Yeah.
We don't account for markets always going up.
Yeah.
When we run our Monte Carlo, there's times when the market drops a lot,
Yeah.
and we have that. And
Yeah.
so, as long as you have a good plan, you can weather this storm, and you should be. You can, if you have a plan, you know what you can handle.
That's a great point, right? I mean, think about it. The market, I think, is down. We just looked at, just you and I before the show started, from the very high point that the S&P 500 to the point it was at when we were looking at it was down, roughly 9%, right? And people are going to be concerned, and because we're so used to the upturn, especially, right? We're going to that statement that comes out at the end of January. People are going to be like, whoa, and but that is part of the financial plan. The financial plan allows, it runs 1,000 times through your scenario, and it allows the computer to randomly choose amongst all of these variables, including the stock market. And so some of those situations are pretty bad stock markets. And so then you can look at your probability of success. So what is my probability of success? Let's say it's 95%. What happens now? Okay, hey, I just had a 9% downturn in the S&P 500. I can run that Monte Carlo simulation again, and oh, look, I'm at 93%. That's still really good. I wouldn't worry about it that much until it got down to the 75% level or less, to be honest. And a lot of people are at 99 and they're just pegged up there. And even with this type of downturn, there is no change at all. So it puts a more longer term perspective into the situation by looking at your financial plan and seeing, because that's the ultimate, right? I mean, it's not how much your accounts are worth, it's what's going to happen to your retirement, right? Whether you're retired or not, what's going to happen to your retirement.